Hi, I'm TaxMax. Let's break down today's tax topic.
Quick tax fact. Closing a company is usually a commercial decision, but the tax consequences often start long before the final step. Closing a company down does not always mean that the business has failed. A company may close because it can no longer continue to trade, or because it has been successful and the owners want to retire or realize the value built up in the business. In both cases, the decision to close is driven by commercial circumstances. However, once that decision is taken, a range of tax consequences can arise, often well before the company is finally dissolved. Before a struggling company is closed, it is common to review whether there are ways for the business to continue. From a tax perspective, this review may involve checking whether all available tax reliefs have been claimed, considering ways of easing cash flow, reviewing how employees are remunerated, and exploring restructuring options to protect business assets. These steps may not always prevent closure, but they can affect timing, cash flow, and tax outcomes. Where a company is successful, closing it down is not the only option. An alternative may be to sell the trade and assets out of the company and then continue managing the proceeds. In some cases, owners may choose to reinvest or hold value within a different structure rather than winding everything up immediately. These alternatives change how profits and assets are realized and how value is retained or passed on. Once a company is on a path to closure, several tax areas can be affected. These commonly include corporation tax on final trading profits, the tax treatment of capital assets, the use of trading losses, the taxation of distributions made to shareholders, and the handling of outstanding liabilities. Different closure routes can produce very different tax results, even where the underlying commercial outcome is similar. If a company can no longer continue to trade, formal insolvency procedures may be required. These can include administration or liquidation. Each route has its own tax implications, including how the end of trading is treated for tax, whether losses can be relieved, and how payments to creditors are handled. The precise tax position depends on the legal form of the closure and the timing of events. Where a company is solvent and successful, owners may decide to close it in order to extract profits and assets. This can be done through a formal winding up process or informally, where conditions allow. The route chosen affects how distributions are taxed, whether amounts are treated as income or capital, and how the company's final corporation tax position is settled. When a company is closing, unusual or one-off payments may arise. For example, payments connected with pension arrangements or payments intended to replace pension contributions may not always be deductible for corporation tax. This is because tax law looks closely at whether expenses are incurred wholly and exclusively for the purposes of the trade, particularly when trading is ending. Closing a company is not just about filing final forms or ceasing operations. From a tax perspective, it involves finalizing trading results, dealing with assets and liabilities, and applying specific tax rules linked to the closure route. Understanding this early helps reduce the risk of unexpected tax consequences at the end of the process. In summary, companies close for both commercial failure and commercial success. Closure decisions trigger multiple tax considerations. Different closure routes produce different tax outcomes, and timing and structure matter as much as the final decision. Closing a company is therefore as much a tax process as it is a legal one. Why did the company close its books early? Because the business story ended, but the tax chapter didn't.
Educational content only, not advice. Rules can change.